The Bank of England, the old lady of Threadneedle Street. Jeff, did I get that right? Is that the nickname?
Yeah, the headquarters used to be on Threadneedle Street in London, City of London.
And wonderful history, weather vanes telling us whether the wind is going which way, and that means that the barges are going to be coming upriver and that you need money. And it's a history that goes all the way back to 1694. Incredible. And so it's a glorious, full, rich history. And you make a provocative comment. You say that maybe one of the biggest changes in that 300-year history was in 1998. Tell us a little bit about what happened in 1998 and then the definitions that we're going to be defining and operating with during this show.
Well, I think there's misconceptions that central banks are kind of like central banks. And, the Federal Reserve has really since 1951 been perceived as this independent institution that just does its monetary policy business, free from any kind of political interference or any other kind of interference, legal or otherwise, too. And there's this, popular perception that the Federal Reserve model is simply what everybody else has done, and that's just not true. The Fed, in many instances or many ways, was kind of the lone case, the lone ranger of independent central banks. And it wasn't until the 1990s that a lot of these other central banks in the era of the Great Moderation, the myth of Greenspan, the Maestro, all this stuff said, we want to be like them. And they started to get, the Bank of Japan was one in 1997's reforms. And the Bank of England actually started to gain more independence from the Chancellor of the Exchequer or the Treasury Department in the UK, which was codified into the Bank of England Reorganization Act of 1998, which essentially said, okay, we're going to give you some independence, not full independence, but we're going to grant you more independence than at any time over the last 3 centuries of your existence.
We're going to be defining goal independent, instrument independent, and inflation nutter. We're going to start with goal independent, and you raise 2 names, Walter Bagehot and Knut Wicksell. Jeff, do you want to tell us anything about Knut Wicksell? Because we've heard lots about Walter Bagehot before. The first time I ever
You're going to get a lot of angry comments from Scandinavians because I think it's Newt.
Oh, geez.
That's okay.
Well, I was going to say
pronunciations. It's one of those things us Americans seem to have trouble with. Sort of the the idea that we just pronounce things the way we do, and the rest of the world can adjust to them.
I'm glad I didn't call him Knut.
It might have been closer to it. Yes, those are just, they had ideas about what central banks are supposed to do and how they're supposed to do it. Newt Wicksell more about interest rates, the natural rate of interest, things like that. Really, it's, okay, what is a central bank supposed to do? What is its job? Walter Bagehot said, well, lender of last resort. When money becomes tight, as you pointed out, when the weather vane changes and the vast British trade fleet start, floating up the Thames, we have to supply money into the marketplace, more money than was there before. Otherwise, a shortage of money will cause a very real restriction on commerce. And we don't want that. That's the worst kind of thing that can develop. John Maynard Keynes, greater evil. Deflation is by far the greater evil than inflation because it causes economy not to happen. And so the central bank's job, according to Bagehot, and using Newt Wicksell's work as a guide, is to try to determine what is the relative condition in money markets, and then act on those relative conditions. Is money tight? Is money loose? What should we do? And what we're talking about here is, what is really a central bank supposed to do? And it's supposed to do something with money. Everybody's, we're told that from the very beginning. Central bank, money printer, printing press, all of these things, currency, money supply. These are all the things that a central bank are identified with. And yet, in 1998, what we start to see out in the open with the Bank of England's reorganization is maybe not so much money.
And also goal independence, maybe not so much either, because it appears to be that the Chancellor of the Exchequer was telling them what their inflation target should be.
Yeah, and
that's quite interesting.
That's a good place to start. That was a fashion fad. It was a fad, really, of the 1990s. It's something that developed in Canada first, which was adopted in many other places around the world, which was, well, we got to do something. We got to attach our monetary policy to something to know how are we being successful. And already you should be thinking, wait a minute, why are we targeting inflation when money, Newt Wixel, money rates? I mean, why aren't you just targeting money? Isn't that your job? Isn't that what you're supposed to? I mean, that's what we're being taught. That's what we've been taught all along. So even the fact that in the 1990s, central banks were transitioning to inflation targets, it's an alarm bell. It's a light bulb going off in your head saying, why are central banks moving away from money and into more economic aggregates as the standards for measuring their policy effectiveness? And of course, we know the answer to that is because they don't do money. They haven't done money in decades by then. And so from the 80s into the 90s, these central banks were kind of groping around in the dark to try to figure out, well, we can't rely on money anymore because we don't know money.
Money supply.
We got to figure out some other way. And what is inflation? Inflation is a monetary phenomenon. So what they thought was, if we target inflation as sort of a tie our policies and real economic variables to inflation, that will tell us whether or not we're being successful, even though, if you really think about it, we don't really know how it's working. We don't understand the details. So what we're saying is we'll start with our policy, we'll flush it down the system and see if it comes out the other end in the way we want it to. And that's really what inflation targeting was to say, we don't know what happens in between, but if the inflation stays near our target, we're going to presume that we're being an effective central bank, even though quite maddeningly, it's because we have no idea what's going on in the monetary system itself. And so already we're seeing central banks are no longer central banks. There's something else entirely.
They couldn't identify, define, measure, or map money, credit, or collateral. So they wanted to see if they could do that for the output, inflation. And they had a team in the Bank of England that was put together, the MPC. And Jeff, as you said, that you couldn't think of a better place to be in the world than London, the city of London, where you could reach into a deep pool, a reservoir of people who understand money, who trade money, who have been in markets for years, decades. And that's exactly what they didn't do.
I know, right? It's
where else in the London, where would you begin to identify, define, measure, and map money? But London.
Eurodollar system, offshore, I mean, all of these weird forms, Greenspan's proliferation of products. London, that's exactly.
MIT, that's
Fred
where
Needle
we need
Street,
to turn
right
to.
on Fred Needle Street. And so as you deadpan there, Emil, that's exactly what they didn't do. What did they do?
What is the MPC? Who's on it?
The MPC is part of this 1998 reorganization. As part of yes, they didn't have goal independence. Let's go back a little bit. Goal independence was that the Chancellor of the Exchequer would still decide the inflation that they were going to target, the level of inflation they were going to target, but they were given what's called instrument independence, which was the Chancellor of Exchequer would no longer tell them how to achieve that target. They were now free to use whatever designs they could possibly come up with in order to meet the Exchequer's target. And that's really in order to do that, in order to come up with these various instruments, and spoiler alert, these are not monetary instruments. In order to come up with the instruments, the policy instruments to meet the Exchequer's target, they created this Monetary Policy Committee, or MPC, which I believe, the governor of the Bank of England is the chair of the MPC. Then he has 4 of his deputies as 4 members, and then the Exchequer nominates 4 outside members. So there's 9 members on this MPC committee, which is in many ways nothing more than the FOMC at the Federal Reserve, except there's the different politics of it.
Jeff, in popular culture, there's several phrases, and they all seem to rhyme together, and they all have that same spirit: flat earther, birther, a Buffalo Bills truther, and now inflation nutter. What is an inflation nutter? What does it have to do with Mervyn King and the MPC?
And actually, I think it has more to do with what we've been talking about in the previous segments of this episode, which is the idea that we should focus only on inflation, that monetary policy should just be inflation. That's really what should occupy any central banker's entire day and in their entire domain. What Mervyn King was saying is that no, there's more going. It's more complicated than that. And an inflation nutter is a policy which only focuses on the inflation rate, or obsessively about an excessive high inflation rate. that monetary policy needs to be more broad-based, more maybe attached to the real economy in better ways, and more cognizant of the fact that that first of all, it's a complicated process, but there's a wide variety of different outcomes.
And you say here that combining these three terms, so combining, where are we, goal independence, not having goal independence, but having instrument independence with non-nutter targeting, meant that they had no understanding of money, which we've been talking about. Do we want to define non-nutter? You've sort of said non-nutter targeting. You've already described that, right? Okay, yes.
Yeah, but that's, by and large, what we're saying here is, and this is not just the Bank of England. This is just the Bank of England catching up with a lot of other places, including the Federal Reserve had already operated in this fashion, which is we don't know how to anchor policy to any tangible outcomes because we don't know money. We don't do money anymore. So what we're doing is we're going to try to do a bunch of things, and we'll target short-term interest rates like the federal funds in the U.S. and the Bank of England has its own benchmark rate. We'll kind of flush it into the system, these rate targets, and we'll see what comes out on the other side. And if what comes out on the other side is GDP growth that's steady and sustained and acceptable with low levels of inflation, we're simply going to presume that whatever happens in the monetary system, fine. It's because the end results are what we want them to be, or close enough to what we want them to be, that we're just going to assume that everybody's doing the job in the way it's supposed to be done, when in fact, that kind of flying blind obviously raises enormous risks when something could go wrong. As Mervyn King was saying, yeah, you could become an inflation nutter where you worry about excessive inflation, or strange as upon strange, something could go wrong in the other direction. Then what would happen?
I think he's throwing shade at the Germans, Jeff. I think that's what he's doing. Oh, the
English
and the
he's
Germans.
absolutely doing that. The Germans the Bundesbank being famous for its, and you can understand why, 1923, famous for their focus on inflation to the exclusion of all of the possibilities.
Rudy Havenstein, once again, coming back into the show. Jeff, one of the things in the 1970s, the monetary conditions got a wee out of hand. And so the United States Congress said, you know what, why don't you come and explain what in the world you guys are doing around here? The Humphrey Hawkins testimony. So the chairman has to go up to Capitol Hill, chairman or chairwoman, twice a year, correct? Okay, super. And guess what? In Britain, they have a similar thing where the head of the Bank of England has to explain why inflation is above or below targets. Tell us a little bit about this delightful little tradition.
Yeah, as we said, okay, the monetary policy, the MPC is free to set the way in which the Central Bank of England is going to work. They flush that into the system and they see what comes out. If what comes out is a CPI measure that's above or below the Exchequer's target by 1% in either direction, the law requires the head of the MPC to write a formal letter to the Exchequer, the Chancellor, explaining why inflation is not within the target area. And so that's what happens. Whenever the CPI deviates, I think the requirement is 3 months, and it might have been changed in the years since then. But anyway, there have been episodes where the governor of the Bank of England, as chairman of the MPC, writes these letters to the Chancellor of Exchequer and usually says, well, this is what we think is happening, and then inflation is probably going to come back down, or this is what we think is happening, inflation is too low, we think it'll come back up. And the Exchequer is required to write a letter back which says, got it, buddy, thanks for the letter.
So you give an example here of May 2010 when Mervyn King wrote to Chancellor George Osborne, and he said because inflation was above the target, but he said, don't worry, temporary factors, VAT rate rise, high fuel prices, duty increase for fuel, alcohol, tobacco, short-term movements, temporary. Okay. September 2010, following on with that, was the MPC's chief economist, Spencer Dale, and he made an interesting comment saying that, there's also continuing constraints on the supply of bank lending. Very good. If you want to comment, let me know. Otherwise, we'll move on to more recent.
Yeah, I think that one was that should have been the aha moment where, because as we know, bank, credit, banking, money, all these things are tied together. And if your chief economist is saying, We're seeing constraints in banking despite all these QEs and low interest rates and all these, our instrument independent policies that we're coming up with don't seem to be working. That's really what he was kind of saying. And so the warning was, don't worry about this inflation. Maybe we should be worried about something else. And really what we're talking, and we should probably raise this point too, the MPC, when it was originally put together, who was put into these slots? Well, the five slots come from the Bank of England, but even those 5 slots, who occupies these positions? They're not bankers. They're not
City of London, former bankers.
Yeah,
Russell
that's what
Napier.
You would think. That's people who know what the printing press is, and they've been in the trenches of the banks. They've worked the short rates desk or the repo desk at one of the major global Eurodollar firms. No, they're all economists. They're all academic economists, PhDs. Yeah. It makes some sense when you understand what central banks have actually become, or what they've been forced to become, which is very different than a central bank. This idea that we're going to create some smoke and mirrors expectations policy, let the system itself work out the monetary details, and then measure it at the end to see whether or not it all worked. That's not a central bank. That's something an economist would do with a bunch of regressions and DSGE models. So it makes sense why central banks over the years, particularly since the early 1970s, have been transformed from being staffed by people who are bankers and know money and money and credit and that kind of thing, to now almost exhaustively exclusively PhD economists, because that's really what central banks have become. They're not central banks. They're not central banks by any legitimate definition of the term. In 2010, you've got their chief economist saying, something in banking, there's constraints in banking. That's already a huge red flag, but yet one of those that goes unappreciated.
You end the essay that more letters will be forthcoming from the BoE. One was already inscribed back in May. But in neither direction do these economists adequately explain the longer run phenomenon. No mention of money nor banks. It's all theater. That is their chief instrument, the same which required that flexibility. Why? Mr. Greenspan now, September 5th, 1997, quote, "In the current state of our knowledge, money demand has become too difficult to predict." That's
really
me, Jeff.
It in a nutshell, right? Yeah. What we're talking about and why this particular episode with the Bank of England is kind of an important episode and unappreciated one is it was the completion of the transformation of a Bank of England from a bank into an economist club. That's really what it is. And that when you understand that money is detached from this economist club, things really do start to make sense, only beginning with 2007 and 2008. You think of, well, how would a real central bank respond to 2007 and 2008? It sure as hell wouldn't have been in the way that an economist club would. And that's exactly what happened. You had these economists all around the world running their regressions saying, well, if we lower the interest rate target a few basis points here or there, we expect that when everything flushes out the other end, things will go back to normal. When all the stuff in the middle that they ignore or they have no ability to actually measure or determine was going wrong in all sorts of different ways, there really is no way for them to get into the system and fix it in the way that Walter Bagehot would have prescribed, because, again, they are not central banks. They are not central banks, certainly in the way the public understands them. And so bring that up to 2021. Here is the Bank of England writing a letter to the latest Chancellor of Exchequer saying, yes, we know inflation's high, it's transitory. But how would they know? They're just throwing darts. They're just throwing conjecture out there because based on their models. When in fact, when the set of letters that the governor of the Bank of England wrote in 2018 said the exact opposite. Why is inflation too low? Well, we expect it to come up because of globally synchronized growth and everything else. So they write all these letters about inflation being either too high or too low with no idea about really why inflation is the way it is. And that's kind of what you would expect of a not central bank unable to really get its hands dirty in the actual monetary business of the global marketplace.
Today is Friday, the 13th of August, and in a couple of days will be the 50th anniversary of the gold window, the gold shock, Nixon going on TV. I believe that was also on a Sunday. Isn't that right, Jeff?
I think so, yeah.
Yeah. And I will be holding a candlelight vigil. I hope you do the same. If the audience wants to join us online, they can do so on YouTube and on Twitter at @JeffSnider_AIP and at Emil Kalinowski.
I will have to say there will be no vigil for me because I do understand the truth that August 15th, 1971 actually did not have as much significance as has been given over the years. In fact, as we have discussed, and I think we intend on discussing at some point in detail, when you actually look at what happened in August of 1971, especially from the perspective of the Federal Reserve, you realize that there's a lot that's misunderstood about August 1971 as well, only starting with the fact, as we talked about before, the Bretton Woods system had already broken down in most of its functional ways long before then. And really what Nixon did in that 50 years ago this Sunday was largely ceremonial.
Jeff was reading the meeting minutes from the FOMC in and around the Nixon shock. And we're going to talk about it next week, ladies and gentlemen. I think you're going to enjoy it. Jeff, have a wonderful weekend. I will talk to you next week.
All right. Look forward to it, Emil.